Wing, are we able to download the slides or is that something we get at the end of class?
Yeah, at the end of the class, you can download it, not right now.
Okay.
Okay, so we're good right now. So we are, this is being recorded. So just, again, mute yourself. So I have no background noise. And then you have your own slideshow in your possession already, but you don't just follow me. That's all you have to do. Okay, are we good to go? Everybody ready for the next 3 hours of intense Zoom training? How cool is that? All right, so without further ado, once again, my name is Si-Wing Yi, and thank you for taking time out of your day. I put together this PowerPoint. This training has been a lot of time to update the slideshow. I mean, for the past few weeks, even before the past few weeks, so to adapt to the current environment. So there are quite a few slides. So I have to go, again, if you want to ask me any questions, go to the chat. Okay, we can talk about, do the Q&A in the last 30 minutes. So this presentation will take for at least 2 hours and 15 minutes. So I'm gonna go through everything from beginning to the end, then we'll go from there, all right? All right, so welcome to real estate investing in a post-pandemic world. Wow. Okay, again, I've been a real estate investor for the past 15 years, and I have assisted a lot of people. And prior to that, I was in the U.S. Army active duty, 20 years of service, and I'm retired active duty U.S. Army back in almost 20 years ago. Is that amazing? Anyway, so after my 20 years of active duty service, then I became a financial planner, then a tax advisor, and then finally in 2006, I became a full-time real estate investor. Okay, so here we are. All right, so let's continue. Let's get to the nitty-gritty. All right, so let me skip to the current conditions. And the current condition is such that we are becoming a nation of renters, right? And this renters nation. So it bodes well for you as an investor. So we foresee that in a foreseeable future, if you were to buy a rental property in a good location, that is, right? You should have very little problem in getting the tenant because of the renter population is growing. People need a place to rent, all right? So I call it rental mania, all right? So, and I'll give you more information about it. Now, here's the here's the acronym that I really like. I mean, this is real estate is a ideal investment. And ideal, I means income, D means depreciation, E means equity growth, A means appreciation, and L means leverage. So briefly, I, as in income, we're talking cash flow. We're talking positive cash flow, right? The rental income, for example, per month, minus your underlying mortgage, your property taxes, your insurance, your property management fee, your 5% vacancy projection, your 5% maintenance projection. At the end of the month, you should receive positive cash flow. That is, that is the fundamental. So income signify that. Then depreciation is a tax benefit, right? You can write off paper loss. You can depreciate your property on an annual basis or even on an accelerated basis. So the income you gain from the rental property, you don't have to report all the income. You have so much deduction associated with it. You have less money to be taxed. So another, and then equity growth. Well, I mean, long term, at the very least, on a historical basis, your asset, your property should appreciate 3 to 4% or more, depending on what location, what time frame, and what have you. But historically, hard assets such as real estate always beat inflation. If the inflation is 3 to 4%, for example, your income and growth should exceed that if you invest for the long term. Does that make sense? So that's equity growth is very, very powerful, right? That'll give you the money you need to retire. So your cash flow plus appreciation equity. And then, of course, the A is sort of same thing. Okay, appreciation, the acronym A. And then leverage, oh my gosh. Leverage is something you cannot get with any other type of investment with the stock market or whatever, because in a stock market or mutual funds, if you invest any money, you pay dollar for dollar, right? You invest $1, that $1 is it. But in real estate, you will leverage, and with the mortgage at a historical rate, you're almost getting like free money to leverage your investment. Isn't it amazing? We'll talk more about this on the subsequent slides. So leverage is a powerful word. So at the end of the day, real estate is an ideal investment. Income, depreciation, equity growth, appreciation, and leverage. All right. Okay, let me see what else. Some of the slides are kind of small. I need my reading glass. So before the pandemic, right, a year ago, the economy was doing good, real estate was doing good. So everything is just humming along, right? And then this shocking event in historically speaking, is just put the world upside down. Right? So all right, let's get back to your situation. I mean, I could say you guys are quote unquote mom and pop investor, for the lack of a better term, right? What does that mean? That means most of you, I assume, have a full-time job, right? Or a part-time, especially a full-time job. So that's fine. And a lot of you, I've talked with many investors, your goal is to diversify into hard assets. I mean, if you have, be nice if you have a balanced portfolio with stocks and bonds, mutual funds, right? And then if you diversify into real estate as a hard asset, that'll give you a very balanced portfolio, and hopefully long-term down the road, you can achieve your definition of financial freedom, all right? And most of you are W-2 income earners, and based on my experience, my student profile, a lot of you are engineers, you are professional, nurse, doctors, or professional managers, high tech, whatever, right? So you have W-2 income, which is very good. So you've got good credit and all that. You have down payment available for cash, for financing. Ideally, you have good credit. Financing is the best way to buy investment property with 25% down typically. Although we don't have time to talk about it. If you have IRAs, if you have individual retirement account, you can even use your IRA to buy investment real estate in the name of your IRA, right? So we don't have time to talk about it. Something I helped a lot of investors over the years to buy investment property using their retirement accounts. Is it amazing? Anyway, all right. So you are who you are. You have some, you have the ability, you have the motivation to attend this class. So it tells me that something is triggering you guys to really want to, improve your finances, and you have to ask yourself, do I have the capacity to do real estate, right? And it's not easy, very, in a way it's easy, in a way it's hard to get into to buy real estate. But I'm gonna show you, okay, obviously I'm gonna show you some real life example, practical information. I'll give you a little bit of theory in this presentation, but a lot of information I'm teaching you today is real world application. It's being done by real people on a consistent basis as we speak. So if you have the motivation, the courage, and the inspiration and the commitment and the goal to use real estate as a form to achieve your retirement future, then this became the right place, right? This Zoom class. All right. So again, even if you're, let me say this, even you are a full-time person, whether you have children or you're very busy at your profession, whatever, you can still invest in real estate. You can buy multiple rental properties and still retain your full-time job, right? And then once you buy X number of properties, some of you are able to use your real estate passive income to replace your job income, right? So I don't know. Everybody have different goals and objectives. So we'll see. We'll see. What's your motivation? Only you know about it, of course. So, all right, let's continue. Post-pandemic real estate investing. Wow, so much has gone on in the past 1 year. So it's very challenging. So let me see. All right, and we'll talk about it. Demand for real estate has far exceeded the available supply. We will talk about it. So it's a very good sign. The fundamentals are really there. And in my opinion, okay, when people talk about real estate investing, there are so many different types of real estate investing out there, right? There are fix and flipping, and then there are like buying storage units or doing multi-investing, doing syndication, doing REITs, real estate investment trust, doing buying apartment buildings or buying foreclosures. There are so many different types of real estate investing. There are so many different real estate asset class. But in my opinion, the best type of real estate to buy is the best real estate asset class, if you will, is single family homes. Single family home investing, residential real estate investments, right? This is the foundation. I believe should be, especially when you are a busy person that you are, again, single family homes and maybe duplex, maybe a fourplex, right? So 1 to 4 unit is ideal starting point for most of you. Does that make sense? All right. And then once you gain more experience, some of you a few years later may venture into commercials and multi-units and apartments or those kind of things, right? So especially if you're a beginner, or maybe you are not even, maybe you have rental property experience in California, then obviously you want to entertain the idea of buying out-of-state investments because the numbers makes sense. I don't have to tell you that buying properties in California, buying rental properties in California does not make sense. The number does not work. The rent to value ratio simply does not work. So you have to go out of state and buy properties that the numbers must work, the cash flow must work, and so forth. I'll discuss more about it. So, what's so funny? Like more than 20 years ago, maybe 25 years ago, the only way you can buy rental properties is buying in your own neighborhood, right? Because you have no other access to find other real estate properties to buy. Then 15 years ago, when I started, the concept of turnkey buying out of state is at its infancy. It has begun. Now we fast forward to 2021. Wow, you know how much real estate investing has changed? Now you can buy remotely. You can buy sight unseen. You can buy without physically needing to go to those areas too. Although the pandemic currently, you shouldn't be able to go anyway. But even, after the pandemic, if you want to, you could physically look at your property before or after you buy. But my experience tells me the majority of real estate investors, it doesn't matter whether you live in California or Washington State or Michigan, whatever, you can buy turnkey real estate investment properties remotely. You know why? Because you are already working remotely, many of you, right? Okay, because of the, we will talk about that, right? So the world, the economy, the world, especially with the pandemic, and the way you work at your job and the way you invest in real estate, it has turned upside down in a good way, okay? Right? So you at your fingertip in your in your laptop and your computer that you're watching me, you can do everything remotely, work remotely, invest remotely. This is the future of the world. This is the future of the US, the future of everything you do. All right, so, and then this book right here, The Big Shift, it tells you about the population trend, migration trend. You might wanna, go to Amazon, whatever, buy one of these books that I'm recommending. So, okay, I mentioned about working from home, right? A lot of you are working from home, believe it or not. I'm working from home. I'm working remotely. I used to meet with clients in my office. I don't need an office anymore. I do Zoom, I do FaceTime, I do whatever, right? You guys do the same thing. So this pandemic has changed the way we think, the way we live, the way we invest. Okay, so all right, so on this particular slide, we're talking about migration, right? Where people are moving and so forth. And as you can see, a lot of people are moving from the urban areas, big cities, into suburbs close by or into affordable markets in other part of the US, which we will talk about on this presentation, obviously. So, a lot of people, as you can see, are moving to mainly South and Southeast because that's where the affordability, it really, really works, especially for real estate investors such as you guys. Yeah, some people are moving to a Pacific Northwest or, other areas, in the Western region of the US, out of the Bay Area, out of the SoCal area, and so forth and so on. So you have to look at the migration patterns, right? You have to look at the migration patterns as a result of the pandemic. Uh, uh, where are people moving to? Okay, then we'll talk about it, obviously. Okay, let's go on. um, so as we said, even when the pandemic is over, you will see around 30 million people or more. They're going to be needing a place to rent, right? Because these are the people that are mostly impacted by the COVID-19 pandemic. And most of these people are obviously blue collar workers in the hospitality and the retail industry, right? And the white collar workers, they are, which is 90% of the US population, are still, for the most part, still are employed, still working and working. They have the ability to work remotely. Not all of them, but many of us are doing that. Okay, so all right, let's go on. Now this chart, or before I go over the chart, let me compare the current economic situation versus the real estate crash of 2008, 2009. It's very different. Okay, the foreclosure crisis back in the last recession are very different than today. And let me quickly go over the 2008 recession. Mainly came as a result of subprime mortgages. People qualifying for mortgages they have no reason to qualify for. So, but today is very different, right? In order to get a loan, you gotta be very highly qualified individual. So today's a very different world, and all the reason why. So I do not expect a foreclosure wave that's coming down the pipe. No, and I will explain more about that. All right. And then if you can see the chart down here, this is a U-Haul, right? U-Haul track the people leaving and people coming, right? If you're leaving from the Bay Area or LA area, if you're migrating, if you take a U-Haul For example, if you go to U-Haul from to go to Austin, Texas, for example, you might have to pay $2,000 one way, right? And the U-Haul people coming from Texas to California, they're only being charged, let's say, like a couple of $100. There's a reason for that, right? So you get what I mean. So this map right here shows the the green color, right? The green circle dot indicates that where a lot of people are going, right? And the red dot indicates where people are, what I call the mass exodus. People are, see the red dot? The mass exodus of people are leaving the Bay Area, so Southern California area, and then the Northeast. You see the Northeast, where New York City, New Jersey, you know, up and down the eastern seaboards. And then, of course, the Midwest, like Chicago Metro and a few other places. Those people, they're migrating into, we see all the big green dots in Texas and Florida and North and South Carolina and Georgia and Kentucky and Tennessee. There you go. That's the migration pattern. All right, so that's what's happening. So another, this chart shows the census. The census have their own chart and pretty much mirror the U-Haul migration chart. As you can see, the darker color signifies there are people moving into those locations, and the lighter color locations where people are leaving. So a lot of people from California, from the Western region, they are moving from rural to suburbs. They are moving to unaffordable markets, such as California, to affordable markets, such as to, you see right here, you see Nevada, Arizona, Colorado, Utah, and Idaho, and Washington State, right? These are the with some of the migration patterns. And then of course you see Texas. And then again, on the eastern area, you will see most people will come into Florida and into Georgia, South Carolina, and North Carolina, and Kentucky, right? But you as a real estate investor, you have to think a little bit differently, right? If you were to buy a rental property where you can cash flow, I'll give you a heads up. The sweet spot, the price, especially for single family homes, residential investing, should not exceed 250K. I'll say it again. In order to buy a single family home rental property, your price you should buy should not be more than 250,000, because the rent, you know, is going to be like 2,000. So that's a sweet spot. So what does that mean? That means the only states that meets the criteria, numerically speaking, are Texas and Florida and surrounding places in the South and Southeast. Now, so, you know, if you are a owner-occupied person that want to go to other areas, that's fine. You know, Denver, Colorado, or Phoenix, Arizona, or Boise, Idaho, or Las Vegas, or Salt Lake City, Utah, or Seattle, whatever. If you want to go to those locations, which is cheaper than California, obviously, but those single family home average home prices is at least 350, 400K. So it's okay, again, for owner-occupied homeowners to relocate to those locations. But as a risk investor, I would caution you from buying rental properties in those locations, because you're not going to cash flow. Does it make sense? Because properties in these areas are more than 300K, 350, 400K average medium home price. So it's not conducive for real estate investors such as you guys. Make sense? I think so. So therefore, the areas that where the number makes sense is South and Southeast, Texas, Florida, and a few other areas where the prices are still very affordable, and et cetera, which I will explain throughout this presentation. All right, so let's go on. This chart indicates when the virus is the virus right now is in charge. But you know, the positive thing is the vaccines available. So they say by this summer, maybe 80% of the U.S. population will have been vaccinated. So that's a very good sign. This is the light at the end of the tunnel. Things are slowly looking good. So until that's resolved, we still, you know, going through a lot of challenges, as we all know, because of the pandemic, right? And all right, so let's talk about, let me see what else. Okay, in terms of, now we all been hearing job losses and what have you, but job losses are really mainly are directed towards those, you know, those workers in the retail and hospitality industry. So, you know, that's what's really happening. So, you know, sometimes the news media paint a very, very bad picture about everything. So they, you know, they only report negative news. So you have to be very cautious what, you know, what news is exaggerated, what news is misleading. But at the end of the day, you know, a lot of people are still doing well. 90% of the US population are still doing very well. And they have a lot of goals to buy homes, to rent homes, whatever, right? All right, so this chart right here, I'm gonna talk about a little bit about high tech, all right? I mean, so this chart tells you at the lower right-hand corner, the bigger areas shows more high tech type of markets. So, so let's talk about it. Or before we do that, this chart shows future foreclosures. Now, again, some of you guys are thinking, oh, I'm going to focus on foreclosures in 2021 or whatever. I personally do not believe there will be a major foreclosure wave happening, and I will show you why. Because currently there are about 3 million homeowners who are in forbearance. Forbearance is not even a negative mark on someone's credit report. They are not in default. I say it again, the 3 million homeowners, right now they're in forbearance, and they are, the forbearance moratorium is still going on. They may even extend it for a few more months, whatever. And the bottom line is America does not want to foreclose on people because the pandemic is happening, you know, it's no due to no one else's fault, right? It's just, so the government will, with their stimulus program and all that, and the state and the county and they have so much, you know, type of program to prevent eviction or for people who are renting. They are preventing the lenders, you know, the lenders are holding the mortgages. They're not foreclosing. They're giving the people out of forbearance. So we anticipate this coming 2021, a large percentage of the people who are in forbearance, they're gonna catch up. Their house is gonna be fine. So we can talk about what the percentage of people will catch up for those people who are in forbearance. The people will sell their house. The percentage of people will actually go through with the foreclosure. But you know, so right again, even after the forbearance means people are, I call it, you know, homeowners are they are taking a quote unquote vacation. They don't have to pay their mortgages, even though many of them they could pay it. So they're having like 12 months or more of not needing to pay their bills and still are able to keep their house, right? So and you know, when the moratorium on payments or mortgage payments is lifted, then many lenders are willing to do loan modifications still. So they will prolong homeowners to stay even longer than they have been this past 2020. If you look at this chart, a large percentage, the orange color signifies that a lot of these people they're going to get caught up. They're not going to get foreclosed because they still have money to pay their mortgages even after the forbearance is over, right? And then, then the blue color portion of the people who are on the forbearance, they they will go through a loan modification, right? So these people are not really under stress. And do you know that at least 70% of the homeowners under forbearance right now, they have equity in their homes. Their homes would never go through foreclosure into a REO, real estate owned situation. The bank does not want to foreclose. The government does not want to see another foreclosure crisis. That's why they're doing their best with the stimulus to prevent all that, right? So a lot of people have equity in their homes. In the past 10 years, the home equity has increased dramatically. See the large percentage of these people, when the forbearance is lifted, if necessary, they can sell their home. When these people sell their homes, whereby the value of the house is higher than the loan balance, they're not under stress. They could sell their homes in a normal market, right? If they want to. So don't believe all the news media sensation and all the YouTube entertainers out there that are calling for a massive foreclosure crisis. Even if the foreclosure people are going to go through the foreclosure, that few small percentage, it takes time to foreclose. You know, it just takes in the judicial states such as Florida and a few other judicial states, sometimes it takes 2 to 3 years to foreclose. In a non-judicial state such as California, yeah, you have to go through the NOD, notice of default. That will take 3 months. Then they will take another 4 months before the paperwork will go through the court system. I mean, it just takes forever. So if anyone are thinking they're going to pick up some great foreclosure deals this year, 2021, well, guess what? It's not going to happen. You could be waiting forever. So there will be some foreclosures in a different part of the market, not all markets, not all areas in the country. So even with a few percentage of people that are going to foreclose in the next few years, their houses will be absorbed very, very quickly by in the normal buying and selling in a real estate transaction. So very few property will go through the bank into the REO. You know what REO mean? Real estate owned? Very few. So if I were you, I wouldn't waste my time either now or the next few years to strictly focus on foreclosures, because you're not going to see too many of them. And the few that will come down the pipe, the few real foreclosures that's going to happen, guess what? They're going to be highly desirable properties. There will be more buyers that are going to buy this few foreclosure property in the next few years. So there will be multiple offers, right? And those foreclosure houses will go very quick, and you are competing against the Wall Street, the hedge funds, the large group of a foreclosure expert. They're going to buy these properties. You, as a as a mom and pop potential landlord, you cannot compete against this limited amount of foreclosures that's going to hit the market in the next few years. Does that make sense? Right? So even when even when a foreclosure come into the market, you're not going to get 30 to 40% discount. No, 10% discount, maybe 15% discount, which is nothing. A lot of time you have to pay all cash. You have to pay money to fix up the rehab the house. A lot of work. It's just very difficult. Okay, for most of you, you have a full-time job. I would not recommend it. All right. So with that said, again, most of the hardest hit by this crisis are renters, right? The unemployment impacts the renters who lives in apartment told us. 90% of the people are still employed. That's the bottom line. All right, so let's talk about the top technological regions. Again, if you want to buy a investment property, you want to buy in an area that, that have a good element of high-tech companies, the high-tech industry. That'll be ideal, although that is not absolutely necessary. So with that in mind, let me share with you some of the high-tech mecca, for example, you could invest in, and maybe not. I'll tell you which one I recommend based on the fundamentals. All right, so with that in mind, okay, some of you, normally I would ask you to take a quiz, but lack of time, what have you, I'm just going to give you the answer to some of these acronyms, okay? As a risk investor, here are the following areas. I'm gonna name them, and then you might want to put on a chat box if you want to. We can review them. Which one of you got it right? All right. So Silicon Valley. Okay, there's an obvious answer. Number one. Number two, Silicon Hills. Number three, the Florida High-Tech Corridor, which is Space Coast, is among the location which is desirable. Number four, Rocket City. All right. Number five, Silicon Forest. Number six, Silicon Beach. Number seven, Silicon Prairie. Number eight, Research Triangle. Number nine, Dulles Tech Corridor. And number 10, Brain Power Triangle. So let's go through the previous slide. I'm gonna give you the answer. Let's see, I wanna test yourself. And the last 30 minutes, you might want to see what's your score, okay? Okay, the answer is number one, Silicon Valley. Whoa, that's San Jose, San Francisco, the Bay Area, right? This is the original Silicon Valley. All right, two, Silicon Hills. Silicon Hills is where? The answer is Austin Metro, Austin, Texas. Silicon Hills, they have, Austin is a series of hills up and down throughout the entire 50 to 100 mile radius. Okay, so Austin, Texas is the Silicon Valley of the South, right? Okay, number three, Florida High-Tech Corridor, Space Coast. That is in Central Florida, a little bit to the Atlantic coast of Central Florida is the Space Coast, the Florida High-Tech Corridor, which is Palm Bay area, Palm Bay, Florida, which is an hour east of Orlando, is Palm Bay, otherwise known as Space Coast. Okay, and we'll talk more about that, by the way, later on this presentation. Number four, Rocket City. Rocket City is Huntsville, Alabama. Number five, Silicon Forest. Where is Silicon Forest? Seattle, Washington. Number six, Silicon Beach. If you don't know this, you are in bad shape. You are in Silicon Beach, Southern California, Silicon Beach, right? Number eight, Research Triangle. You know what that is? That's in North Carolina, Raleigh, North Carolina, Charlotte, North Carolina, Chapel Hill, and Raleigh, and Durham, yeah. Research Triangle right there, okay? And number nine, Dulles Tech Corridor. That's really in Northern Virginia, all right? We're talking across the river, across the Potomac River. Northern Virginia is, I used to live there. Reston, Arlington, Virginia, Fairfax, Alexandria, and even Washington, D.C. have a lot of high tech. A lot of it is governmental, but still a lot of high tech. So that is the Dulles Tech Corridor, Northern Virginia, and even part of Washington, D.C. And last but not least, the number 10, the brain power triangle. So a lot of you know that the brain power triangle is in Austin area where you have Harvard and MIT and those universities that are producing those, very, very smart young millennials. Okay, so out of these top 10, let me give you another quiz. Okay, you might want to disclose that when we do the chat. So which of these areas should you invest for cash flow? All right, can I answer that right now quickly because we don't have too much time. Obviously, you should not buy in Silicon Valley, right? Too expensive, okay? That's where I live. And then Silicon Hills, yes. Austin, Texas, yes. Many single family homes, not many, are 250K and below. So you should be able to get cash flow at 25% down payment. So yes, for Silicon Hills, Austin Metro, and Florida High Tech Corridor, yes. Space Coast, you can cash flow, low price, 200K price range. So you can get cash flow at 25% down payment. Rocket City in Huntsville, Alabama, definitely yes. You can buy property for about 100,000 to 120,000, and you will cash flow in that market. And number 5, Silicon Forest, Seattle, Washington, no, right? The single family home median price is around 400, 450,000. You're not gonna get cash flow. The rent are not gonna cover the, your debt obligations. Number 6, Silicon Beach, obviously your area, very expensive, not good. The numbers does not work in SoCal, Silicon Beach, okay? Number 7, Silicon Prairie. You know where that is? The prairie, like a plains, like a flat land. That is in Dallas, Fort Worth Metroplex. Yes, a lot of high-tech companies in the Silicon Prairie. Yes, you can still cash flow in Dallas metro area, barely, right? You can buy a home for like 220K, 250K, single family home rental, and it rents for like $1,700 to $1,800, right? So that's yes. And number 8, Research Triangle, Raleigh, Durham, Chapel Hill, even Charlotte, barely cash flow. The price point around 230, 250K, and the rent is like 1,600, maybe 1,700. So barely cash flow, 25% down. So I would say Research Triangle is a lukewarm checkbox. Yes, that's it. Dallas Tech Corridor, very expensive. Northern Virginia, Washington D.C. is, median price of homes are like 500,000 or even more, right? So no, as an investor, do not go there. And number 10, no, brain power triangle in a Boston Northeast area, very expensive. Yeah, should not buy there. All right. Okay, let's go on. Let's talk a little bit about the, let me see what else. Good markets. Now, what's happening with the, well, as a result of the pandemic, people are leaving high density areas. They're leaving urban. They're leaving, not everybody, of course, but many people are leaving apartments, multi-units living conditions, and they moving into the suburbs. So this graph shows that the retail, the commercial, and the apartments and the multi-units, a type of asset class, are not going to do well as a result of the pandemic. All right, and also this slide indicates that due to technology and what have you, you can buy real estate. Does not matter where you live, does not matter where you work, and you can. There's no limit as to what geographical region you can buy. All right, and again, the future of real estate investing is live where you want to live. You like living in Pasadena area, that's fine. Some of you may want to move later on for retirement or vacation home. somewhere else more, affordable or more space, whatever, right? But live where you want to live and invest where the numbers makes sense. All right. Well, okay. And the three concepts I want to share with you, which is critical for as a real estate investor. The three acronym are OPM, which is other people's money, OPK, other people's knowledge, and OPL, other people's labor. OPM, powerful. You using other people's money. What does that mean? That means that you're using the leverage. You're using a loan. You're using a financing with a historical low rate to leverage your home. So you buying a asset, which with 25% down payment, you only put your money at risk at a quarter of the asset value, and you're gonna allow a lender, other people's money, to get a mortgage for you because they trust you, because you have good credit, because you have down payment, because you are good in financial management and all that. See, other people's OPM, other people's money and other people's knowledge is that you need to surround yourself with a team. You cannot be a lone ranger. You cannot be an expert in certain areas. You need to leverage the power of a financial team. So yeah, you should know the basics of tax and legal stuff, asset protection, whatever, right? But you need to find yourself a team of real estate tax advisors, real estate legal advisors, real estate whatever, right? So you can leverage off their knowledge so they can help you, right? To buy and to do well financially. Does it make sense? And finally, OPL, other people's labor. I mean, I don't know about you, because I'm not going to manage the property. Okay, I'm gonna use a property manager to manage my property, especially far away. And in terms of a rehab, I'm not gonna, what do you call it? I'm not gonna use a hammer. I'm not gonna use a nail. I'm not gonna do any kind of physical work. Okay, I will leverage my team, other people's labor, the contractor, the people on the ground to fix my house, right? I'm not gonna do no TNT, tenants and toilet. I'm not gonna, right? I'm not gonna evict the tenant. I'm not going to fix the house, rehab the house. I'm not gonna do the dirty work, right? And you should not either. You leverage other people, right? You pay other people to do it for you, right? You're buying an asset class, a hard asset, where you have other people do everything for you. You know, you are working smart. You don't have to work hard. Yeah, you should work hard too, but you should work smart. Let all those people on the ground work hard for you. Okay? OPM, OPK, and OPL. Very, very important. And down here, this picture indicates that right now, the mass exodus from the major areas such as San Francisco, LA, Chicago, New York City, New Jersey, Boston, and Chicago, did I say Chicago? Those people are leaving the urban environment to go to the suburbs. And this graph shows that this is an epic migration pattern, okay? Follow what's going on, all right? So how to design your real estate portfolio. So when you buy a single family home rental property, you could put down 20 to 25% down payment to finance, okay? But if you're gonna buy a duplex or fourplex, you need at least 25% down payment. Anything 1 to 4 unit, you can use the favorable Fannie Mae lending guidelines with the lowest possible interest rate for investors, typically around the low 3s, which is amazing. Okay, so so how you design your portfolio, you keep on leveraging, okay, assuming you have the money for the down payment and all that. Then also something we're not going to talk about. You can use your IRA to buy as well, as you can see. And then you buy turnkey, right? You will buy a property which is all ready to go. You know, the renter are in place, the property has been rehabbed, everything ready, at the property management or can find a tenant for you. Those are turnkey type of investments, and the research and due diligence for the most part has been done for you. You don't need to do excessive amount of research to buy those kind of properties out of state, all right? So there's no such thing as the national real estate market. Real estate is local, okay? Real estate is local. Every neighborhood, every city, every region have different real estate activities going on, right? So do not think real estate is same everywhere. No, real estate is very local, it's very specific, down to the street, down to the neighborhood, all right? Okay, keep that in mind. All right, let's talk about loans a little bit, okay? We're talking Fannie Mae lending guidelines. The currently maximum is 10 mortgages per person, all right? So let's go over the specifics because your ability to get the OPM is critical. All right, now, so low inventory plus low interest rate plus rising pent up demand equal real estate hot markets, right? Which that's what we're seeing right now, right? I'm sure in your down here in SoCal, same thing as in Bay Area, right? There's a shortage of homes, multiple offers is everywhere. So it really everywhere in the country are going through the same challenges. So historical mortgage rates, you as an investor, you are most likely going to get low threes, like 3.3 to 3.5% investment loan rate, a little bit higher than, you know, owner-occupied properties, but which is amazing, right? So if you buy duplex or fourplex, the rate could be a little bit higher, you know, the high threes, the low fours, which is still amazing. All right, so again, per person, right, if you fully qualify, you can buy up to 10 mortgages with this favorable Fannie Mae lending guideline. Then if you're, ideally, if your spouse, right, also qualify to get loans, then if you really want to buy a lot of properties, the one spouse max out his or her first 10 mortgages with the Fannie Mae lending at 25% down, for example, single family home rentals, for example, then the other spouse, assuming he or she qualify, right, get the 10 mortgages under her name. So you buy mortgages under each individual name, not under joint name. So if your husband married, right, you can get maximum is 10 mortgages per person. With two person combining, you could buy 20 properties with 20 mortgages and meet that Fannie Mae lending guideline. Does it make sense? Now, what if you have you want more properties beyond the 10 property limit with the Fannie Mae, Freddie Mac, right? The general rule is to you have to go commercial. You have to buy 5 units or more. You have to buy multi-units, more than 5 units. But then, you know, we're talking like hard money loans, lending, right? You have to find a portfolio lender that will charge you a higher interest rate, higher down payment. The terms of the loan is not 30-year fixed rate, those kind of things. So, and plus the property is much more expensive. So what I found is that very few people go beyond 10 mortgages, Fannie Mae, because for commercial is really a different ball game. It's just, you know, it's very hard. But I do have a partial solution for you, which is coming up right here. A lot of people do not know, because me being an ex-US military, I have access to this niche real estate market, which is called government VA foreclosures. Like, again, we don't have enough time to talk about that, but You can buy, you can buy VA foreclosures. A VA foreclosure is a homeowner that is a ex-veteran like myself. They initially they bought their home with 0% down payment, VA loan, right? Veteran Administration loan, 0% down payment. And later on, for whatever reason, whether due to death, disability, or divorce, or other kind of financial crisis, they no longer can pay the mortgage because they put 0% down, so they have no skin in the game, for example, right? So they rather walk away from the property. So that property will become foreclosure, VA foreclosure, not the other kind of foreclosure. So so as a result, when you find these kind of properties out there in the current market, which you can, you as an investor can buy these properties, these government foreclosures with only with a Vendy loan, a different kind of loan, not Fannie Mae loan, not portfolio loan, not commercial loan, nothing. You can use we call it Vendy, VENDE. As you can see, Vendy loans. As an investor, if you have more than 2 years of rental property ownership experience, you can buy this government foreclosures with a loan which is 5% down. 5% down, no PMI, right? You do not need to be a military veteran to buy this government Veteran Administration foreclosures. 5% down only. Is that amazing? Okay, yes, you can. Okay, you're not going to get this information from the mainstream people out there because of my background. I know this niche market. It's just not that many of these VA foreclosures, but enough for some people who qualify to get this 5% down, right? But okay, the only caveat is the rehab cost you have to pay anywhere from $5,000 to $10,000 to fix up the house. It come out of your pocket also. So it's not just the 5% down. The 5% down plus the rehab cost plus the closing cost is your total out of pocket. So still, it's it's amazing to leverage a property like this. OPM, again, OPM is you buy with 5% down and the government, the VA, will give you the other 95% loan. How's that for leverage? Okay, and those properties are in good locations, okay? They are highly desirable property in good areas, good rental market, good appreciation potential, the whole 9 yards, okay? All right, see? By paying this small fee with the Pasadena City College, I think you're getting some value add proposition, right? I'm sure, you don't have to say yeah. Okay, so that's good. So you're learning something you're not aware of. Now you know. All right, so, okay, there's some additional details about the Vendy loan. Yes, you can do it. There's a lender out there that will do this kind of 5% loan for investor. You do not need to have to be an ex-military. You can be anybody as long as you qualify with 2 years of ownership prior property experience and you qualify for the loan, you have the down payment, you can find these deals. And for example, to buy a VA foreclosure with 100 grand, 5% down is $5,000 down payment, plus $3,000 closing costs, plus maybe $10,000 of rehab costs, cosmetic rehab repairs. Total out of pocket, we're talking how much? Not even 20,000, right? And or you can buy a nice property for VA foreclosure property for 200,000, 4-bedroom, 2-bath, whatever. Very good area, high quality house, 5% down, which is 10 grand, 5% closing cost, 15 grand, and $10,000 rehab cost, total of 25,000. For anywhere from $13,000 out of pocket, you can buy VA foreclosure price range is a 100 to 120K. $25,000 total out of pocket. You can buy a $200,000 single family home via foreclosure in a very good location. It'll the other thing is, with 5% down, the best you can hope for is a break-even cash flow or a slight positive cash flow, $100 to $200. Make sense? That is the expectation moving forward. Some of you qualify, some of you are beginning investor. You don't qualify yet. You have to wait 2 years after you buy your first property, then you qualify after 2 years. Some of you already qualify. You know who you are, right? So that's the end. That's the name of the game. So very, very good program, which is very few people have knowledge of this. All right, and this is some of the examples. This chart is a current listing of the government via foreclosure. Again, from a high level, these homes are nice homes. They are built within the past 10 years. They're in good neighborhood. You know, the interior of the house is very nice. Is only cosmetic repair is necessary. That's it, right? And of course, you need an inspector to inspect the house. You need an appraiser. You need a property manager and all that to help you, in those locations, which is really not hard to do, right? So some of these properties are in Texas. They are located in good markets in San Antonio, Texas, in outside Austin. You can find these properties. You can find it in Florida, in good areas of Florida. These houses are typically $200,000, $150,000, $100,000 in a good rental area. Now, a lot of the deals that you see here does not qualify. They are located in an isolated area. There are very few rentals in the location, whatever, right? So just pick the right one, and then you can do it, all right? So many different type of great houses. As you can see, very nice. Look at these homes, interior and exterior. The neighborhood is nice, is a C plus B and B plus neighborhood, all right? See, this past week, there are about, I think, 15 of the listings. There are 4 of the listings that make sense. The one over here in the middle is located in, I believe, in the Tampa, suburbs of Tampa, Ruskin. And the previous one down here to the lower right-hand corner is located in Hudson, Florida, which is, 30 minutes north of Tampa. Only costs $162,000. The one on to the lower left-hand corner, I believe is in Ocala, Florida, which is like 1 hour north of Orlando. Very good area, $183K via foreclosure. And the one in the middle at the top is located at in, I think, Spring, Texas, which is outside Dallas, I think. Again, very nice area. By the way, this kind of properties are typically in the multiple listing servers. Is multiple offer situation. For each good property that you're seeing, there will be 5 or 10 other offers competing against you. So require a little bit more work to make it happen than the other type of turnkey investment properties. Make sense? So, but it's very much doable. It's not that many of these around. These kind of properties goes very, very fast because they are so attractive, because they are so desirable. They cash flow, they have long-term appreciation potential, the whole 9 yards. Okay. All right. So every week the listing changes. So it come and go. So any investor that want to get involved in this kind of purchase system, the government via foreclosure, you gotta be proactive. You gotta pull the trigger very quickly, then do your due diligence afterwards. You have to make an offer, you have to compete against other people, but it's doable. I'll give more details later, okay? Anyway, all right, so this is some of the cash, I call it pro forma, cash flow analysis. I know the print is kind of small, but You have the slideshow. You can use your on your cell phone. Uh, you know, other from this meeting. When this meeting is over, this Zoom is over, you can the slideshow that you have. You could take a picture with your cell phone or of this this spreadsheet, and you can enlarge the numbers, and you will see the all the cash flow, the rent, you know, the mortgages, the cash flow, the rate of return, all those kind of things. Okay, and I just give you some example. I gave you like 3 examples of this pro forma cash flow analysis. The one in San Antonio also looks very nice, 159,000. I think it rents for like $1,450. Very good rental market. Okay, so good property. All right, so to recap about the 10 maximum loans, yeah, there are other options other than, you know, commercial. After the 10 loans, VA properties purchase is one option. Okay. All right. So how are we looking with time? Now 1 hour into it, so we're halfway through at least. So we're good. We're good. Look, if any one of you needs to take a break, you may free to do so. I don't know that you're doing it. So drink your second cup of coffee, or you could even eat your breakfast at the same time you're watching my Zoom class. All right. So again, this Zoom presentation will be recorded. So a few days later, this coming week, I will email you a copy of the Zoom video replay. So isn't that nice? Isn't that amazing? Isn't that swell? Yes, it is. Yes, it is. Okay, how to design and build your real estate portfolio. All right, so you buy for geographic diversification. Do not put all your eggs in one basket, right? The numbers make sense, right? As long as you do the numerical calculation, which I will show you what are the numerical benchmark associated with analyzing each property. I will show you in the next few slides coming up. All right, and then your investment horizon, you should have a long-term buy and hold strategy. Okay, I mean, I'm not going to tell you. You know, I'm not going to tell you you're gonna you know, you're gonna achieve amazing wealth short term. No, is, you know, buying and designing and building your real estate portfolio is a long-term journey. Okay, it's not going to happen overnight, so it requires a lot of inspiration, perspiration, courage, and focus, and all those mental attributes that you need to become a successful long-term passive investor. Okay. So buy and hold forever. Why? Because if you sell your property too soon, you are going to kill the goose that lay the golden eggs. Each house that you own is a golden goose, right? That lay the golden egg. You know what are the golden eggs? The golden eggs are the multiple streams of rental property income. Isn't it amazing? Risk investing is such that if you find a good quality tenant, they can pay down your mortgage for you over the next 30 years or less, right? Wow, this is such a beautiful concept. Think about it. If you want to become a successful investor, all you have to do is find a tenant or several tenants in the next few years. They can pay down your mortgage. What a tremendous concept. So there's a lot of tenants out there right now and in the future. They'll be more than willing to rent your high quality house and will become a very good tenant, actually, given today's environment. And they are going to pay down your mortgages. It's just amazing, amazing concept. So, wow. amazing, amazing way to invest. So the goose, the lay the golden egg, the longer you keep each of your rental property, the more uh, uh, golden egg that you can achieve, which is the cash flow, the multiple cash flow monthly and the equity growth. Those are the golden eggs that you're getting. All right. So, okay, let's talk about the 4 formulas. Again, I don't want to spend too much time. It's sort of a dry subject. It's sort of a little bit technical to some of you, right? Math is not a lot of people's forte unless you are a engineer or in healthcare world. You understand numbers better than a lot of other people. But I have to educate you about the 4 critical numerical formulas that you need to understand because knowing these 4 formulas will make or break you, all right? And they are, bear with me, I will explain this to you in layman's term, even though the terminology itself sounds very technical, just bear with me, all right? Again, the repetition is the mother of all learnings. So even though you may not get it, what I'm trying to explain to you right here live, once you do the replay of this Zoom video, then and learn more about it, repeat the process, and you will get it. You know why? Because over the years, I like watching movies, right? I mean, I especially like watching movies back in the 60s, some 50s, 1950s, 1960s, and 1970s. Those 3 decades, I love watching those classic movies. And over the years, I've been watching those movies ever since I was a little kid. I mean, I've been watching classic movies for like 50 years already, living here in the US. And a lot of these movies, whether it's Gone with the Wind or Wizard of Oz or The Sound of Music, I couldn't tell you how many times I watched these movies, multiple times in my lifetime. Each time you watch some of the movies, then you can realize, I didn't know this, I didn't know that, because the previous time, something you just couldn't catch it. When you watch it again, then it all comes together, right? Same thing with real estate investing. The concept you learn initially, even right now, today, you may not understand a lot of it, but again, you'll come back, repeat the process, replay the video, and you're gonna say, oh yeah, I mean, the light bulb just certainly appear, you click the light bulb and you see it. If everything comes together, you get it, right? Okay. Oh, here they are. Okay. Okay. Here are the 1% rule. Rent to value ratio. Not quite exactly 1%. A little bit less than 1% is okay. Okay. The technical terms are the 1% rule means if you can buy $100,000 property, your projected monthly rent should be around 900 to 1,000. That's almost 1%. If you get that, you will cash flow. Okay, let me just get it out there. If you're gonna buy a $150,000 property, all you need is a monthly projected rent of $1,250, $1,300, $1,350, right? It's almost 1% of the value of the property. Then with 20 to 25% down payment, you will achieve positive cash flow. When you buy a property for $220,000, follow the rule. You may not get the 1% rule, but if the 0.07% or 1%, which is fine. For example, on a $220,000 property, if the projected monthly rent is like $1,700 or $1,750 or even $1,800, it meets the rule because you put 20 to 25% down payment, you will have positive cash flow of $200 or $300 or even $400 monthly net. Does that make sense? 1% rule, rent to value ratio. So therefore, if you buy any kind of single family home that are more than 250K, forget it, right? So as I taught you earlier, all the areas that I mentioned, the west of Mississippi, California, Washington State, Oregon, Idaho, Utah, Arizona, New Mexico, Nevada, all those areas does not cash flow because the median price of single family homes is way above 250K. Are you clear? All right, I think you are. All right, so the second numerical formula is a capitalization rate. Okay, all you need to know, okay, I'm not gonna spend too much time because it's very hard to explain. Capitalization rate is the net operating income divided by the purchase price. So the capitalization rate does not incorporate your mortgage, the leverage portion of it. So the capitalization rate need to be at least 5%. Okay, that is the benchmark. So net operating income divided by the purchase price. Net operating income means your annual gross rent minus your annual taxes, insurance, and property management fee equals whatever divided by the purchase price, and you will get 5% cap rate or higher. That is a desired benchmark. All right? Actually, it's not that hard, right? So the capitalization rate will give you the real return, not incorporating the mortgage, the leverage, because when you leverage your investment, your returns are much higher than normal, right? So capitalization rate is a pure, down to earth, very precise metric. Okay, so your annual gross rent plus your annual property taxes plus the annual insurance and annual property taxes, whatever the number is, divided by the purchase price. So your capitalization rate needs to be 5, 6, 7%. Then the property makes sense cash flow wise. All right. And finally, maybe not finally, cash on cash return. Cash on cash return incorporate the mortgages that you're using to buy your investment property. So cash on cash return means is a very good benchmark because cash on cash return means your annual cash flow divided by your initial cash invested. That means let's say you buy a $100,000 property, you put 25% down payment, right? And your monthly net cash flow, let's say, is $500. I'm just giving you a simple example, okay? So your monthly net cash flow is 500. Multiply by 12 months, your annual net cash flow is 6,000, right? 500 monthly net, multiply by 12 months, it's $6,000 annual net cash flow. So your down payment, which is 25% down payment, percent down, multiplied by $100,000 purchase price, is $25,000 plus $5,000 closing cost, for example. So your total out of pocket invested is how much is it? 30,000, right? So your $6,000 of annual net cash flow divided by your $30,000 of total cash invested, which is your down payment plus the closing cost, equals what? In fact, I don't even know. So let me calculate this on my cell phone quickly, all right? So your $30,000 of total money invested divided by $6,000 of net annual cash flow equals 20%, right? Am I right? $6,000 divided by 30,000. Yeah, 20%. That 20% is the cash on cash return. What does that mean? That means the $6,000 it'll take 5 years to recoup your total down payment, right? So 6,000 first year, 6,000 second year, 6,000 3, 4, 5. So it take you at the end of 5th year, right? At the end of 5th year of ownership, your annual net cash flow will pretty much pay off all your initial money you put in to buy your property, right? That's 20% cash on cash return. So that the benchmark is anything cash on cash return of more than 8% is deemed a good purchase. That means you will cash flow, you and all that stuff. Does that make sense? And total ROI down here, up here, total return on investment is your projected annual appreciation at the end of the first year, plus your annual net cash flow. You combine those two, equals whatever the amount, and divide that by your total amount invested, equals your total ROI, total return on investment. It could be 15, 20 to 30% result, right? Okay, all right, so that's it. Let's go on. All right, so the benchmark, now you see the benchmark, right? 0.07 to 1% is the rent to value ratio. And then the cap rate, 5% or higher. And then the cash on cash return, at least 10%. So yeah, all right. So okay, now the real nitty gritty, where to buy? Okay, let's get to it. All right. Okay, you buy in location, migration, right? You buy in. Okay, here's the benchmark. You buy in a location there where that market have a little bit of a high tech or a lot of high tech companies, right? You buy where there are Whole Foods in the area. You buy where there's a Amazon distribution center. You buy where there's a large hospital or of that area have a high concentration of healthcare industry, right? Workers. You buy an area where there's a large military base. I mean, ideally, not, or even more than one military base combined with the other metrics, then is ideal, right? What else? And then, of course, good diversified economy, financial services industry are located there, or a good manufacturing, or a good retail, good, for example, an area where a sort of a destination, a vacation destination, or retirees are also living there, right? Entertainment, and okay, so yeah, those are the ideal market where you should, and of course the affordability, and the single family homes metric is less than 250K, right? So that's pretty much it. So where to buy? So you can buy, there are two schools of thought. So having said that, where to buy? So you should buy either in the Midwest or in South and Southeast. Okay, let's go through it, the big picture. Now, I would say the ratio of real estate investors that are buying in the Midwest versus the buy in the South and Southeast, I don't have the real numbers. I have to say is like 30-70, maybe 40-60. So 40% of investors buying in the Midwest and 60% of investors buying in the South and Southeast. Let me tell you why. Now, and then, you have to create your own criteria. So the bottom line is, if you want to buy with a high cash flow, with high, cap rates and cash on cash return, you buy in the Midwest. Midwest, or where? Like Ohio, Illinois, Indiana, upstate New York, or Ohio, Tennessee, Missouri, Michigan, right? those are Midwest regions. Those are like blue collar, right? Those homes are cheaper, right? Very cheap, sometimes like as low as 50,000 to 100,000, right? The challenge you're facing is those homes are old. They are either 50 years old or even 100 years old. And so those are high cash flow markets, low prices, low down payment, but the appreciation potential are not all that great, right? You're buying older homes that require fix up potentially down the road, and the tenant or like a C class, B minus, C class, C minus type of neighborhood, those kind of things. So you have to decide what business model, what criteria that will make sense for you. All right. So I know you can't see that well right now, but I just provided you with some cash flow analysis pro forma for your review later. So you can find single family home, like I said, 60 to 80 grand. You can find duplex in the Midwest for 60,000 to 100,000. A fourplex for 200,000, right? And don't get me wrong, these are good rental markets, right? But the pros and cons I just shared with you. So you have to decide whether that is the criteria you wish to pursue. High cash flow, right? Lower price, uh, older homes. So if you want a real estate portfolio of high rental income, high cash flow, then the Midwest market is good for you. Now, conversely, if you wish to buy in the more cutting edge, a lot of high tech, booming market, large metro, not newer homes, more potential for appreciation, then you should target emerging market. So newer homes are either new construction or newer homes built in the past 10 to 20 years. So the prices in these areas are, like I said, anywhere from 150 to 200 grand, right? New construction in the emerging market, but the cash flow is not as high, right? But the potential of appreciation is higher, right? Higher down payment, newer homes, better tenants, more potential for appreciation, and less vacancies, less repairs, less headache, less maintenance. But the cash flow is not as high, and but yet to project into appreciation as well, right? So, and those markets, as you can see here, are typically on Florida. And by the way, Florida and Texas, I mean, you could juggle, they could be right at the top in terms of number one in the country in job growth and number one in population growth. And that's all you need to know, really, if you think about it, right? So, so that's really it. Florida, like the best area to buy, the best area to buy for cash flow in Florida is Central Florida and Southwest Florida. Central Florida would be Kissimmee, Poinciana, Palm Bay, Ocala, Sebring, Tampa area. So the Central Florida is quite large. It's an Orlando metro, and then 1 hour to the east into the Atlantic coast, and 1 hour to the west into the Gulf Coast of Mexico, to Tampa metro. So that area, the prices are very attractive to investors. The homes are less than 220K, new construction mostly, ideally, and the very good, very fast growth area. Okay, and then the other area in Florida would be Southwest Florida in the Gulf of Mexico area. Of course, do not buy too close to the coastal area. Do not buy in Miami or Fort Lauderdale or in the panhandles, because those are not desirable. Too expensive, too much hurricane, natural disasters. So avoid those areas. But yeah, Central Florida, good. not subject really to natural disasters, and it's affordable. You can cash flow a lot of plenty of renters. Same with Southwest Florida, which is Southwest Florida is a good area uh, with cash flow possibilities. They are like Cape Coral, Fort Myers, Lehigh Acres, Port Charlotte, LaBelle, and those areas. Southwest Florida, also very affordable, good for investors in cash flow, good rental market, good infrastructure, the whole 9 yards. All right. And then in the other areas, clearly is Texas. I mean, you've been hearing about it, right? A lot of you know what's going on. The mass migration of people from California moving into affordable areas. A lot of those people go to Texas for very obvious reasons. So Texas I call it the Big Four. The Big Four are Austin, San Antonio, Houston, and Dallas. So that is my idea of the Big Four. So let me break it down. The Austin Metro, like a 50-mile radius of Austin. Inside Austin is already too expensive. $400,000, $700,000, $800,000 houses, right? In the good areas of inside Austin. Forget about it, right? You need to buy in the outskirts of Austin within a 50-mile radius, and the locations are like New Braunfels, Kyle, Texas, Hutto, Manor, San Marcos. Let me see where else. Temple, Belton, Killeen, Georgetown, and Round Rock, right? So you can find those new construction for 220K or less, between 200K and 240, and rents for 1,600, 1,800. You can cash flow a little bit at 25% down, but you're talking appreciation potential because the Texas, especially Austin, in San Antonio also, Austin is amazing, the massive growth. So the thing is, okay, how to buy? I mean, one thing I would not recommend, especially you guys are full-time, you work full-time, you don't have enough time to do too much research and all that. So the best system to buy, my recommendation, you buy from a turnkey provider. There are companies out there, you do your Google, you watch the YouTube video, right? Turnkey provider. There are not many. There are some companies that have a infrastructure. They sell you a property using the turnkey business model. Turnkey means those companies out there in the marketplace, they have done all the research. Their builder have built the best home in the best location. They have a property manager in place. They have loan agents, title companies, inspectors, and closing companies. All is a one-stop shop that could, you don't have to do that much work. You just leverage the track record and the reputation of those turnkey provider in those various locations, especially in the South and Southeast. And then you can be very successful. So again, you have to do your research, but there are a number of companies that are very reputable that can help you buy these turnkey properties where the properties are rehab. They spend all the rehab money, they put a tenant in place for you. It's like they giving you a silver platter. Like you go to a dinner, the waiter will bring a silver platter, everything prepared for you. The meals are all ready. They have done all the ingredients. They have a good meal. You don't have to do it yourself, right? You're buying the real estate on a silver platter, mostly all done for you. That is the ideal world, okay? All right, so turnkey provider, they do all the work up front. They buy the houses, they rehab it, everything else. They everything, and then they sell to you as a retail real estate investor from out of state. Does it make sense? All right, so yeah, so that's what they do. And then what's next? Then let's make a deal, right? You heard the TV show, Let's Make a Deal. Yeah, then pull the trigger. So let's recap on those. Right now it's 10:46, so we are on time. All right, so let me look at this. Yeah, so you, if you were to become a lone ranger and go out there, do everything on your own, right? If you search the multiple listing service, if you buy those typical resale homes out in the market, wherever it is, I could pretty much assure you that it's a very challenging process because of the shortage of homes. You're going to run into multiple offers from other people that will try to buy those homes. There's high competition and you can rent a bidding war. So to avoid that, so you buy properties, new construction or otherwise, through a turnkey provider. That way, you're not competing in the open market to buy those resale homes, which is very difficult. For example, in Austin, Texas, I mean, for every house that are available, you're getting 30 to 40 similar offers. Is crazy over there. I'll discuss more about it. Right, so let me see what else. So for the foreseeable future, the rental market is going to be very strong. There will be all the people that are impacted by the pandemic. Eventually, they need a place to rent, and why not? You rent it to those people. So, all right, right now is the greatest time to buy. New construction is the best, in my opinion. New builds are the best real estate asset class. All right, let me tell you why. Again, the new construction primarily in Texas and Florida will be ideal, although there are new constructions located in North Carolina. There are a few in Georgia, then there are a few in Louisiana, but they are not as good as in Florida and Texas for the reasons I just stated to you. So let me share with you a few benefits associated with buying new construction. It's just that you can go to a builder. The builder, they have a build to rent business model. Some of the builders out there are turnkey providers. They specifically target investors. Okay, so you're not competing against other investors from out of the blue, whatever. You're not competing with Jack and Jill and Tom, Dick, and Harry. You don't want to compete with the Tom, Dick, and Harry of the world. So you just go to a provider that have those properties available for you to buy. All right, so you buy, you buy the lot, you pay the earnest deposit, then you wait 4 to 6 months. When the house is completed, then you do the loan, then you close escrow, then you get the property ready to be rented by the property manager. All right, let's look at the big picture. All right, let me see how much time we have. We have around 30 minutes left for this presentation, then, which is gonna run into 11:30. Then from 11:30 to 12 o'clock, 30-minute Q&A. So I ask you to put down your questions as we speak. Put down on a chat box, and when I complete this presentation in about 30 minutes, I'm gonna review all the questions in the chat box, then I will answer it. Maybe not only that, you could open up your video again. You could unmute yourself and you can ask me verbally. How's that sound? Like you did at the beginning of this Zoom class. All right. So if you want to do that, perfect. I would. In fact, if I have a lot of questions, I could even go beyond, a little bit beyond noontime, a little bit beyond, our official time. So it all depends. Okay. So you open your video, talk to me face to face. Okay. I would love that. I miss the live interaction. Okay. How we can substitute for that is through Zoom face-to-face interaction, like we're doing hopefully shortly. All right. So let's look at the big picture. Right now, historically low interest rate. Do you truly understand how amazing is this? All these years I've been doing real estate investing, I have never seen interest rate on mortgages this low ever, right? So, I mean, for owner occupier, you're getting a less than 3% rate. This is mind-boggling. For investor, you're getting the low threes, which is amazing. Some of you, if you can go back in the 1980s, all right, you know what I'm talking about. Interest rates at that time, it's like 13, 14, 18% during those days, and people still buy real estate. Okay, this kind of mortgages you're getting here in the U.S. right now on historical low rates, the foreigners, people who are not U.S. citizens, people who are not in the U.S., they don't get this kind of mortgages. They don't get this kind of interest rate. People in Europe, in Australia, in Asia, in Canada, wherever, they don't have it as good as what we're having. I mean, it's like almost free money, right? The lenders, the government are willing to finance your property purchase. They're willing to risk 75% of the price of the property to give you a little bit higher than 3%, 3.2 to 3.3%. It's almost like free money. So your risk is dramatically lower because your at risk is only 25% down payment. You're buying a $200,000 property with only 50 grand of cash. That's it. Wall Street stock market never has and never will give you this kind of leverage. The more you can leverage with good debt, your rate of return is higher. All right. So this historical low interest rate, I believe, will continue at least for the next 2 years. Beyond that, who knows? Lock in your rate. Lock in your investment mortgage rate at 3.3%, whatever. Fix mortgages, because years down the road, inflation is going to go up, cost of living going to go up. The price of goods and services go up, but your mortgage payment will remain the same, fixed rate. Do you understand what the mind-boggling benefit you're getting? So for those of you who have good credit, they can qualify for financing, that have the money for down payment to buy rental properties. Come on, there's no time to wait, okay? You buy real estate and wait instead of wait to buy real estate. Wow, come on, this is like winning the lottery. Historically low interest rate. Okay, Case-Shiller. Case-Shiller is a very reputable resource that track home prices, long-term, short-term cycle, whatever. As you see as you can see this chart, right? On the right-hand side, it indicates the last few years. Okay, the middle, the mountain top, that is at the peak at 2009 real estate crash. Then the crash occurred down, on the other side of this peak around, 2010 to 2015, 16. Then 2017, 2018, 2019, 2020 is on the trajectory. So Case-Shiller home prices indicate that 2021 and beyond, given what's going on and the economy and the marketplace, expect your real estate home prices will continue to go up. The reason why is record low inventory. There's a lot of reasons why the inventory is low because the inventory is low even before the pandemic. I already seen it. I mean, the builders are not building enough homes. And during the past 10 years, ever since from the last recession, there's population growth and the builders all over the country have not kept up. They have not built enough homes for many, many reasons. So right now, especially with the pandemic, a lot of people were not willing to have people walk into their house and to do this, you know, this open houses. You know, a lot of people normally would have sold their homes this past year. They are staying put. So that will exacerbate the low inventory everywhere in the country, not just in your own backyard. So low existing inventory creates huge and the high demand because of the low interest rate. People can afford to buy more houses, higher price houses because the interest rate is so low, the payments are so low. So there's a tremendous demand, right? Because of low inventory. So again, the builders are trying to ramp up, but the demand has far exceeded the number of new constructions. So it's not easy to build new constructions, right? It takes a lot of time to get the permit from the local city. Then you have to find the lot to buy. So the builders are trying to ramp up, but they are really, really behind. It'll take the next few years before there will be new homes to accommodate the demand that we are seeing, even during the pandemic. I mean, real estate really are not affected by the pandemic that much at all, okay? And for those of you that want to venture into buying new construction, the builders know that. The developers in the country, they know that. But getting the lot, for the developer to get the lot to build the new homes for people are not that easy, right? There's not, there's a finite number of lands available. So developed lot are in short supply. So the builders are fighting tooth and nail, right? To find a lot in different part of the country to build the homes. And the timeline to build the home from beginning to the end to completion, it takes time, all right? So lots are in short supply. And then furthermore, there's a shortage of lumber that are needed to build the homes. So as a result, we are seeing skyrocketing lumber prices are increasing the home prices, the new constructions. The cost of lumber, the cost of appliances and kitchen appliances and water heater and air conditioners and everything else is going up. So whenever you see, you try to buy a new construction home, the builders are increasing the prices on a weekly, monthly basis. That's what's happening, right? Cost of material rising and likely to rise as builders compete for supply. New home inventory is low, as we mentioned. And then I believe there will be a V recovery. You know what I mean by V recovery? Right now, we're all the way at the bottom, but toward the end of this year, 2021, and once the vaccines are successful, then you will see a very sharp recovery of the economy. So that's how I feel, V recovery. So why is so much demand? So much demand because there's a lot of jobs out there still, right? Especially white collar jobs everywhere. And then the migration, the population growth, especially in areas of Florida, Texas, as I mentioned, the mass exodus of Californians into Texas, the mass exodus of people from New York City, New Jersey, and from the Northeast into Florida. So when you see this kind of a trends, that's you can get demands because not enough homes to buy or rent. And of course, those two areas, Florida and Texas, have a good affordability with low interest rates and cash flow scenarios. Florida and Texas is sunshine, 365 days a year. I love warm weather. I don't know about you, but you know, even I wouldn't want to live anywhere else other than warm places. California, which is my home base, Texas and Florida, sunshine. You know, I mean, what more can you ask for? And good activities, good amenities, and laying on the beach, just soak up the sun. It's just such a tremendous thing to experience. And plus, Florida taxes, or they have no state income taxes, right? If you, you know, I know a lot of people, friends, relatives of mine, maybe even myself, eventually, if not now, they are looking forward to go to Texas and Florida to retire, to buy vacation homes. Then you have millennials moving into those areas because they of the ability to work remotely, right? You don't have to go to work anymore for a lot of people, so they can live and work and wherever they want, even though, you know, their their companies are located at certain places. Okay, and of course, U.S. population will continue to rise through immigration, through larger family units, people having more babies. That's what's happening, right? The U.S. population will continue to grow, and the housing is not keeping up. So it's all fundamental of economics, right? When the demand is high, like it is right now, and the lack of supply, so you have this imbalance, right? And so that bodes well for real estate investors. Okay. All right. Source of investing, you know, your down payment cash, your IRAs. Okay, I'm gonna focus on two markets that which a lot of people do not know. Some people might know. Just some bonus I'm gonna share with you by attending this Zoom class. This Rocket City is the potential. Is Rocket City is picked as the home of the new Space Command headquarters. Rocket City, just so you know, is in Huntsville, Alabama. So by being in the military, I know what's going on. They have created the military have created a new branch. It's called Space Force, right? Currently, there are 4 military branches, right? U.S. Army, Marine, Navy, and Air Force, and maybe Coast Guard. But each branch of service, typically, it all depends, you know, it has like 300, 400,000 active duty soldiers in each branch, which is huge. So the last time the military has created a new branch, it's like 1949, right after World War II, when they created the Department of the Air Force. Because before 1949, the Air Force is part of the U.S. Army branch. But anyway, so now they're creating the Space Force. And the headquarters of the new military branch, the Space Force Command, is located in Huntsville, Alabama. So now you know. A lot of people does not know, by having this Space Command headquarters in Huntsville, Alabama, will make this market better because it'll create more jobs, more active duty soldiers going to be stationed here. Then you have government contractors, you have civilian contractors, you have aerospace companies moving into this area to support this military branch and its mission to fight in space, et cetera, et cetera. So not many people know about it. The home prices in this area for investors is only about 100,000, 120,000. So undervalued home prices for investors. The mainstream media are not aware of what's going on. I know because of my ex-military background. and all that. Okay, so just so you know, some additional bonus you're getting from attending this Zoom class. And then there's another, I call it Silicon Valley of the Southeast. Now, the Silicon Valley of the South is in Austin, Texas, and as many of you know, but I'm creating a new terminology, Silicon Valley of the Southeast, which is in Florida. Where in Florida? Palm Bay, Florida, which is in the coastal area of the, along the Atlantic coast of Florida, which is around 1 hour east of Orlando. Palm Bay, next to Palm Bay is this Space Force. Again, same, the US military branch Space Force is having is being built up in this area, which is in Patrick Air Force Base, which is 10 miles north of Palm Bay, just so you know, okay? Space Force. So the mission of the Space Force is to fight in space in the future, okay? Let's give you some, what else is going on in the Space Coast, okay? Palm Bay, Florida is quote, end quote, Space Coast. We're talking Cape Canaveral, where all the the rockets and missiles and all the space, what do you call it, are being flown in Cape Canaveral, right? All those, what you call it? Oh, those. Anyway, so look to the stars. The future of the U.S. military Space Force, which is a very big deal. They are going to ramp up. And by the way, in the Space Coast, Palm Bay area, SpaceX is a civilian, is commercial or ramping into space, not just the military or involved in the space technology, right? So SpaceX are the cargo capsule launches supplies to International Space Station. And then, right, and then there's a history-making mission. The Jeff Bezos, by the way, the richest man in the world, the CEO of Amazon, he is in the space program. He's doing commercial things out there. Okay, so if Jeff Bezos speaks, we listen. Furthermore, the aerospace company Lockheed Martin, they looking to land astronauts into space in a few years by the year 2024. Furthermore, they have the Apollo to Artemis mission, and whereby they do a lot of space, civilian commercial space exploration, okay? And then they're gonna send astronauts who will land on Mars in the foreseeable future. And then another, Richard, as you can see, Richard Branson, the British guy that owns Virgin Airline and all that stuff, he's also moving into space technology. So he's putting some commercial projects out there as well. And of course, last but not least, you have Elon Musk, the CEO of Tesla. He is in the area, in a Space Coast area, doing the SpaceX commercial exploration. So the titans of the world: Elon Musk, Jeff Bezos, Richard Branson. They are spending a lot of money to get into space, among others. And many aerospace companies are located in the Space Coast, Palm Bay area. So that's then for, what's happening also, there will be a time in the next few years where they're going to have a tourist like us. If you have the money, if you have $100,000, you can go to a space balloon. Okay, you can on the space balloon you fly up 10 miles into the atmosphere and enjoy your this tourist attraction, once in a lifetime opportunity. Space perspective, looking to offer views of the Earth from 100,000 feet above surface. Okay, space balloons. Yeah, so that could be somebody's bucket list, right? If you have 100 grand to spare as a tourist, you can go out in space. Isn't that cool? So that could be one of my bucket lists. I don't know about you. So modern space race. So this is what's happening. China orbits moon as Russia launches new satellites into space. So there's a modern space race going on, okay? And their money are being funding space innovation. Investors commit to funding. There are many investors. We're talking Wall Street investors. We're talking, the high-tech world, the Silicon Valley of the world. They are entering space technology. Okay, space travel is happening. So, as a result, the area of the Cape Canaveral, Port Canaveral, Palm Bay, Melbourne, that area of Florida is the housing market is booming, and right now, still is affordable. Single family home there is only a new construction only sell for like $225K. It rents for $1,750. So with the housing in the area of Space Coast is, for the lack of better term, is quote unquote skyrocketing. The future ain't what it used to be. All right, let's talk about another great market, which is amazing. Austin. Austin is the next Silicon Valley. For those people that are gonna move to Texas, if they take up residence in Texas, they do not pay state income tax. Same with Florida, right? So that's part of the reason why people are moving there. This past year, 2020, of all the people moving everywhere, Sunbelt Rising, this chart shows that the Austin this past year has the #1 in population growth in the country in the year 2020, all right? Just so you know. And part of the reason is Silicon Valley of the South. Oracle, if you have not heard, a short time ago, they are moving their headquarters from the Bay Area to Austin. So Larry Ellison and Oracle are moving. That's a big news recently. Then Elon Musk, he's having a huge $1 billion manufacturing plant outside Austin. Is being built as we speak. That will bring at least 5,000 jobs into the area. So needless to say, Willis Housing in the vicinity of this Cybertruck assembly plant outside Austin will bring a lot of growth in the area, and housing prices is, as we speak, is skyrocketing. Okay, and Elon Musk. And of course, this article indicates that not only Tesla employees are being relocated to Austin to work in the manufacturing plant, they're going to expect skyrocketing housing prices and the surrounding area of outside Austin. And then, of course, in case you have not heard, Apple have a second campus already located in Austin, right? There's a second campus. This campus is as we speak are being built, and it's going to bring in 15,000 jobs, mostly high tech. So clearly, Austin have a lot of high tech, and a lot of people from the California is moving there, high tech employees, given the fact that they can work remotely and what have you, given the prices that California housing is so high, you can go to Austin and pay a quarter of the prices and live like a king in Austin. So therein lies the problem. And then in the future, this corridor of Austin and Texas, really, California, I believe, if I'm not mistaken, is the state of California is the 6th largest economy in the world. Maybe not much longer because so many people leaving California, but Texas is the world's 9th largest economy. Okay, so Texas right behind California, but soon Texas is going to exceed California in terms of the 8th or 7th largest economy in the world, right? So Texas is America's economic engine. So the projection is that the Austin and San Antonio corridor is a mega region. That means San Antonio is only 1 hour below Austin, right? So the entire landscape from Austin down south into San Antonio and all those little cities in between is absolutely exploding. Okay, housing prices it's a tremendous shortage, multiple offers, people overbidding, but there are some opportunities for investors still to pull the trigger in the Austin metro. So the projection, the US Census Bureau indicates that in the next 10 to 20 years, the population growth in the Austin, San Antonio mega corridor region will be around 50% population growth in the next 10 to 20 years, which is kind of unheard of, mind-boggling actually. Okay, and the housing are not keeping up with this influx of people and companies moving to Texas and Florida because the Texas and Florida are very pro business. They, unlike California, right? Very high taxes in California or making not only high-tech companies, but other kind of companies leave California and New York to come down to Texas and Florida, and population and companies moving to these locations will change the landscape of Florida and Texas forever. So this is I know it's hard to see the numbers, but if you want to buy properties in Austin area, you have to buy in the suburbs of Austin. And as long as you can find houses, hopefully new construction, if you can find it, because it's so hard to get, the inventory is so limited. But again, if the house you can buy for $240K or lower at 25% down, you can cash flow as indicated on this pro forma cash flow analysis. So 25% down on this property located in Temple, like 1 hour above Austin. The price is $180,000. You put 25% down payment, you have a net cash flow at the lower right-hand corner around how much? $316. But appreciation potential obviously is very, very strong. So you're not necessarily buying for cash flow, you're buying for potential strong appreciation, at least for the next, several years, at least, okay? Then another location that could be ideal is located in somewhere in the northeast area of Austin. Is called Jarrell, and the prices there are very doable. It's around $200,000. You put 25% down payment, you're gonna get about $150 monthly net cash flow. And finally, this property is located in New Braunfels, I believe. Yeah, which is 20 miles below Austin downtown. And the price there on this new construction is like $220K. It's hard to see. It rents for, I don't know. It rents for maybe $1,600 monthly, and you have a net cash flow of around $381 at 25% down payment, which is not bad. Okay, so this is what you can expect. Ooh, okay, let me see what time. Are we almost to the end? Oh yeah, 11:21. We're almost to the end, people. Yeah, we are. So as a result, so I'm gonna. All right, so the PowerPoint presentation is over, and right now it's 11:20. So what we can do is do some Q&A through the chat box. So perhaps I could look at the chat box, or if you want to, you can unmute yourself with a video. You can ask me questions visually, right? Anybody wish to do so? While I'm looking at the chat box with some questions. Quite a few questions, okay? Let me pick on some of them at this moment. Okay, one question is, do you recommend creating a business entity before investing in real estate? Good question. Do you recommend creating an entity before you invest in real estate? I get this question all the time. My answer is most likely no, especially when you're gonna buy the property without financing. The lender would not allow you to buy a property under the name of an entity because you're using a loan. So what you should do is go ahead and buy the property using your name with the loan. Then when you close escrow, then after you close escrow, then you can feel free to put the entry structure into the property. Does that make sense? All right, very good question. Can you discuss, another question is, can you discuss how to use your IRA for buying investment property? Yeah, it's kind of complicated. I don't have time to discuss about the IRAs. Again, with your implied permission, I'm going to put your email into my newsletter, free newsletter database, and I will send you videos and information about how to use your IRA to buy real estate, which is a very, very powerful strategy. And a lot of people do not know about it. But I have done many, I have helped many investors to buy over the past few years to buy investment property with the IRA. So yeah, I'm very well versed in that space. And very good question. And would you require renters to get rental insurance? No, because there are so many renters out there. You can pick and choose to find the best tenants. You do not need renters insurance because again, the rental market is so strong right now. That's really not necessary. Okay, and let me see, there are some more questions. What is the name of a popular turnkey provider in some Midwest or Southeast cities? Use a turnkey property seems like the easiest way to go, right? Yes, again, I do not recommend you guys go out there on your own, do everything yourself, go to the multiple listing service. You're gonna be so frustrated. All I can do, okay, as an educator on behalf of Pasadena City College is is for you to Google YouTube video, turnkey provider. The Google search would be turnkey provider in whatever city you're exploring. Turnkey provider in Texas. Turnkey provider in not Texas. Be more specific, in Austin. Turnkey provider in Cleveland, Ohio. Turnkey provider in Buffalo, New York. Turnkey real estate turnkey investing in whatever city you want to pursue, right? Hopefully I answered that question. All right, another question is, please share your tip for finding a good property managers. Again, Google property managers in the city you are contemplating. You want to do something. The property management profession is getting a lot better compared to the old days. The old days when I started back in 15 years ago, oh, there's so much incompetency associated with the property management profession. But now, given the maturity of the industry, giving the all the systems and high technology, and the real estate growth everywhere, the property management is getting a lot better. So, like I said, Google property manager in a specific city, and you might see 3 or 4 companies out there. Then click on their website, right? If the website looks very professional, nicely done, they have pictures, and then that's a good sign, right? But the turnkey provider, if you're able to find those organizations, they should have an in-house property manager as part of the whole turnkey package. Does it make sense?
What kind of fees can you expect to pay for like a property manager or turnkey provider? What kind of?
Yeah, that's a good question. So typically, if you get a property manager on your own, normally the standard pricing in the industry is 10% of the rent, 10%. But if you go through a network, if you go through a turnkey provider that accommodate many investors, they can give a discount. The discount could be as low as 8%. Ideal is 8% property management fee, 8% of the rent. But if you go through a group, if you go through a network, which is you get those discount, but normally it's 10%. Okay. All right. Any more questions verbally, facial wise, or chat box? I will continue to look at the next set of questions from the chat box. I have some more. Another question.
Hi, Mr. Yee. I have a question about the FHA loans. If I'm a first-time buyer, like my husband has bought property, do you recommend looking into doing that, or what's your thought about that?
Yeah, FHA is really for principal home buyers, right?